Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome back to Equity Mates Investing, a podcast where we explore what is possible in the world of investing. If you've just joined us for the first time, a massive welcome. Today we are exploring the world of global equities. To chat through it as always is my equity buddy Ren. How are you?
I'm good, Bryce. I'm just laughing as you say that intro because...
Very broad.
Some may say that every episode we explore the world of global equities.
Yes.
Some may say that's close to the reason this podcast exists.
I like to keep it broad and mysterious.
I guess the difference is in this episode, we have an expert helping us explore the world of global equities.
That's right. We are chatting to Catriona Burns, who is the lead portfolio manager responsible for WAM Global, listed on the ASX WGB. And this is where we're going to talk about global equities.
Yeah, this will be a really interesting one. We're going to start with investment strategy and philosophy, but we're going to get into what's been happening with the Q1 earnings season. There's been an uptick in mergers and acquisitions activity. I mean, here in Australia, the big one has been BHP's big move, but over the world, there's been a lot. We're going to talk about the AI thematic. Catriona has some different ways that she's playing it, not just the big tech companies.
Yeah.
So a heap of interesting questions that we're going to pick her brain on.
And then closing out with a deep dive on one of the stocks that is interesting her in her portfolio.
And before we get into it, just a massive thank you to Wilson Asset Management for making this episode possible and helping us keep it free. But with that said, let's get into it.
So we want to start with the overall investment approach that you take as lead portfolio manager at WAM Global. So can you help us understand and perhaps define your investment philosophy?
Yeah, so we're basically at WAM Global and look across various of the funds at Wilson Asset Management. We're looking for undervalued growth companies, and in the WAM Global portfolio specifically, it's, we're looking around the world, not just in Australia. Our philosophy is that ultimately earnings drive share prices. Sure, in the short term, it might be rates discussions or, expectations, but ultimately, if companies can deliver strong earnings growth, share prices will follow. And so that if we can find advantaged businesses in good industry structures run by high quality management teams and we don't buy them at ridiculous prices, that the performance for the fund will do well. So that's kind of the belief that we have as investors.
Now, there's a few different elements there and a few threads to unpack. So I guess how does that philosophy then translate into your day-to-day investing at WAM? Can you bring it to life with a couple of examples from the fund?
Sure. So, day-to-day, we are, spending our time talking to the management teams of the companies that we invest in. We're talking to competitors, suppliers, customers, industry experts. We're seeing hundreds of companies a year. You're always trying to test. You invest in a business, you have a thesis on why, your view might be different from those in the market, but you're constantly trying to, test that thesis, assess new bits of information to say, is your thesis holding up? And so that's what we're doing each day, both trying to test the thesis on the stocks that we own, but also try to identify new investments for the portfolio. Like in terms of real world examples, say, we've got various companies across the portfolio in different, sectors and so forth. But a good example might be in the healthcare space, for example. We own businesses such as Thermo Fisher Scientific, Avantor, Icon. Our thesis has been that, we owned them, we trimmed them because we were concerned on inventory overhangs post-COVID. And now what we're seeing is that we're seeing basically slowly that inventory is being worked through, and we have a view that these businesses over the long term will compound earnings, high single digit, low double digit. They'll be able to, short-term headwinds right now are temporary, and these are very high quality businesses that, will see strong share price outperformance over time. So, we have a thesis. We have had a differentiated view in terms of, where earnings were going to go. And so we've been able, we had a position, we trimmed a position, and we've added back to a position through the life cycle of new information coming through.
So, Catriona, you're a brave global fund manager to benchmark against the MSCI World, but not have any of the Magnificent Seven in your top 20 holdings. So can you talk about your view on these 7 tech giants, and I think also how you think about investing and, more importantly, not investing in them?
So our view on the Mag 7 is that each of them are very different in nature, and so you have to look at them individually. So Tesla compared to Apple, compared to Nvidia, completely different businesses and different drivers. And so we look at them individually. We are not, we don't have a blanket view that we don't want to own any of them. We do own Google. We thought that, the concerns on them being behind in AI, etc., were overblown. So we have owned Microsoft. We've sold it more recently just on valuation grounds. So we're not anti the Mag 7 in any way. We are seriously underweight. So we have about 2% versus 20% of the MSCI World Index. But that doesn't mean we will always. It's just a view around what's our marginal differentiation for those stocks right now, and do we have a differentiated view? Is there valuation support? I mean, there's no doubt on the quality of, depending on which one you're talking about. So, we think Microsoft's a wonderful business. We think Google's a wonderful business. We think Tesla makes great cars. The valuation isn't necessarily great. Apple, the growth relative to the valuation, we don't think particularly interesting right now. So we're not at all anti-Mag 7. We will own them, if we see compelling upside. Right now, the only one we own is Google.
Now, a lot of the performance of those 7 companies, well, some of those 7 companies, has been driven by the thematic of the moment, which is AI. And as we were preparing for this interview, we read an article you'd written recently about investing in AI, but outside of the 7 tech giants. So can you talk to us about how you're approaching this AI thematic and some of the companies in your fund that are sort of different ways to play it?
Sure. So we are real believers in AI and the enormous potential that generative AI has. We've got lots of holdings in the portfolio that are benefiting from AI. Yeah, so we're not. The view is just we're playing it not in different ways. So, for example, we've got a big investment in a business called Quanta Services, which they do all the maintenance and upgrade work for the electrical and transmission grids in the US. So the largest player at what they do, the electricity and transmission grids and the communications infrastructure is going to see pressures you haven't seen it ever before. One ChatGPT search is like 10 times the electricity demand of a Google search. So you're going to have enormous requirements placed on the grid. And interestingly, back in, so this is a business I've known for, 15 plus years and run by an outstanding management team. And interestingly, in the global financial crisis, lots of the utilities completely started outsourcing maintaining and upgrading the grid because they needed to, cut costs and so forth. And so Quanta became the biggest player in doing that. They signed long-term agreements with all the utilities to maintain and upgrade the grid. And so as all these requirements are being placed on the grid, these guys are doing all the work to upgrade and maintain it. And we think it's an interesting way to play AI that is not obvious, as if you said, okay, how are you going to play AI? It's just a nice. We think power demands are going to be, enormous, and it's a great play. Other things we own, say, we think the large language models are ultimately going to become commoditized. Like you've got, whether it's Bard, Llama, Chat, GPT, you're even seeing it already happening. And so it's not necessarily the models or the CapEx heavy. Like Nvidia is an amazing business and has been and it had an incredible run. but there's no guarantees that their demand's not going to be cyclical. So we think you're better to play data, because the most important thing that's going into AI model, the integrity of the data is the most important thing. So you play companies that have unique data, and you play companies in that software layer. So a great example would be SAP, which, everyone thinks boring SAP, but that was for us the opportunity, because who has access to the most insane data? It's SAP, because they're the ERP backbone of massive corporates all around the world, and they're implementing AI into their own business and into their product suite for their customers. But it's not necessarily a business that you naturally think, oh, that's an AI beneficiary. We own Intercontinental Exchange, CME Group, the exchanges. Again, data, they have incredible data. So we think they will be able to utilize AI in a unique way. Intuit, another example, leader in tax software, unique data, started implementing AI across their product sets 5+ years ago. Booz Allen Hamilton, they're the biggest contractor to implementing technology into the US government. So if the US government is no doubt compelled to adopt AI, and there is no company better placed than Booz Allen Hamilton, which is a US listed company, to do that. They're the leader. We think the valuation doesn't reflect the tailwind that they have. So lots of different ways to play AI that aren't just Mag 7. And look, we've seen that they're benefiting. The portfolio has been able to keep pace with the market despite not having the Mag 7, which is because these companies are still benefiting from AI, but they're just not in that Mag 7 list.
If there's one thing we love at Equity Mates, it's a list of stocks for us to go and look at. So thank you for that, Catriona. Also, a side note, we were talking about this on the show recently. We found it fascinating that Microsoft have come out and said that they're actually looking at developing their own nuclear reactors to accommodate the surge in demand and data centers that they're building themselves. So this whole space is just fascinating to see how it's playing out.
Exactly. That's so true. Quanta, for example, that does all this maintenance and upgrade work, they would have never before talked to the big tech companies, but they're having huge conversations, because if you're doing a data center, what do you need to know? Where is the power that's going to supply it? And so the data center used to be, the most convenient location is X, but now it's we don't care where it is, just tell us where there's enough power for it. And so they're having conversations with all the tech companies that they never had before.
Yeah, I love these. I love thinking about these different ways to play it, because it is such a transformational shift, and there will be so many different winners. So yeah, a good list for us to go and research. But Catriona, I guess we want to zoom out a little bit and talk about global markets. Now, we're speaking to you. You're over in New York at the moment, and so you're sort of, I guess, on the front lines of some of these global market conversations around inflation and interest rates, and what's sort of driving, I guess, the bigger stocks in the global markets as a whole at the moment. So before we ask your view on where next, let's just ask how it factors into your process. So how much, as a global fund manager, and particularly as a stock picking global fund manager, how much are you thinking about some of these macro factors?
So we are very bottoms up in terms of looking at the fundamentals of the stocks that we invest in, and what do we think earnings are going to do. But there's no doubt you cannot avoid the discussion around macro and the consideration of the macro backdrop. And I mean, one of the things we think that in terms of our process that in some ways gives us some insulation from whatever happens is in the macro is trying to pick industry leading businesses that have pricing power, etc., that ultimately, even when you get because I mean, the topic of discussion of the last 2 years is when are we going into recession, and so on again, off again, soft landing, hard landing, no landing. And for us, it's if you're invested in wonderful businesses that can grow in spite of the macro, you'll come out okay the other side. Sure, growth might slow for these businesses, but your hope is that you've got great management teams running them that take advantage of any, downturn to take share, to invest when others aren't, etc. And so for us, it's, the tenets of our process is like industry position. Is it advantaged? Does the company have an advantaged industry position? Has it got a high quality management team? What's the earnings growth outlook and the sustainability of that over time? And then coupled with a valuation, like is it a reasonable valuation? And then can we find catalysts? So we think that you're never going to avoid macro noise and, discussion on rates and, where are they going? What's inflation doing? Is it sticky? Is it not? Blah, blah, blah. So, but if you invest in great businesses over time that can grow and have and the other tenet is a lot of our businesses are, the majority of our businesses have strong tailwinds, structural tailwinds. So we think that provides a degree of resilience in their earnings. And yeah, sure, we're going to have business cycles, economic cycles, recessions, whatever. But ultimately, high quality businesses, that can grow earnings will outperform.
So having said all of that, do you have a view on where we go from here?
You can't avoid the noise.
Well, we took a pretty definitive view early in the year that the 6 rate cuts that were priced in to us looked ridiculous, and it was too aggressive in terms of that we were going to get 6, just because we were seeing such resilience on the ground in particular in the US that it felt too aggressive that we were going to get 6 rate cuts. Now at 1, who knows, that's all gone out. For us, we prefer to call the stocks rather than where the inflation data, will go, or GDP growth. We can, every economist is famed for getting it wrong constantly. So look, our view is pick long-term winners. Our preference is that rates go down because that'll be, more positive for less of a headwind for equity markets. But staying flat's good enough. It's if we get rates going back, actually being moved back up, which would not be my base case, I think that's going to be a much bigger headwind for equity markets.
Well, Jerome Powell said, whilst he's not cutting as soon as he expected, he still expects the next move to be down. So fingers crossed for equity markets around the world. But I guess let's move to what is more sort of your focus, which is individual companies, finding those winners. And a great time when we get a massive dump of information is the seemingly never-ending reporting season you have over in the States. Every 3 months, every company reports, and we're getting towards the end of Q1 2024 reporting season. So what have you seen? What sort of stood out for you? And I guess how are you factoring all this new information into your process and your thinking around some of these companies? At
the headline level, it's being reported that there's, it's more beats than expected, blah, blah, blah. But that's because expectations were really brought in coming in. So sure, you get more beats. We think actually it's been quite mixed. There's no doubt all the headlines are around ramping AI, CapEx spend from the Mag 7, etc. So that's definitely, and that is happening, there's no doubt. They're investing massive amounts and that will trickle down, then companies are and so forth. So there's no doubt that's been a massive thematic, is that just the massive spend going on in infrastructure, data centers, etc. The consumer it's really mixed in terms of the feedback. We own Visa and they had a great result, very strong, very solid. But then you've had Starbucks, Messi, McDonald's calling out pressure on the low-end consumer. Estee, and we don't own any of these, but Estee Lauder, for example, today fell 15% because they had a cracking result, but they've got zero visibility on the outlook, so have been really conservative, and so missed expectations. And so the consumer, and then you've seen Nike and Lululemon, etc. They've all had tough results. So it's not across the board healthy. There's definitely CEOs calling out pockets of pressure. And then, even in the trucking business, you've had the market was pricing in no cyclicality, and then they come out with results that are less than stellar, and the stocks fall 20%. So to the good is like anything related to CapEx for the tech companies. I mean, even in the healthcare area, we've had some, like we own, say, HCA Healthcare, which is the largest private hospital operator, still seeing very solid growth in hospitals. Icon, that does clinical trials into the healthcare spend for the pharma companies, still very strong. So you've got like decent pockets of strength, but then you've also got pockets of weakness. So my overall, summary would be it is mixed, and below the surface, it's perhaps less healthy than you might read from a headline of, stocks beating, expectations, etc.
Do you own Netflix, Catriona?
We don't.
Oh, the reason I ask is because I noticed in their recent reporting, they said they're no longer going to report their membership numbers and like revenue per subscriber. Yeah, which I just thought was really interesting. And I imagine if it's in your portfolio and you're an analyst, you'd be like, that's how we value this business.
Yeah.
But I just thought
it's just what they know. So that's why they're taking it away from you.
It's an indication of, I guess, what's to come in the streaming wars and where that business sits. They've just decided we're no longer going to be reporting this. So it's just going to be top line revenue. And
that's so strange.
Yeah.
One way to frustrate analysts with their
numbers. I assume there are some numbers that a company has to report. Like a company couldn't say, we're not going to report revenue anymore.
No revenues. No profits.
But I guess other than that, what it's their discretion what they report?
Yeah. Well, but I mean, there's interest, like when you've given something and you take it away, like usually you have to keep giving more. Like if you take away something, that's where you really frustrate people. So often like you've got companies that don't give enough, and so they're constantly getting badgered to, can you give us more? Can you break this down? So usually they're becoming more open in disclosures. When they go the other way, it's usually not a great sign.
Yeah. Well, there you go.
Anyway.
So one other, I guess, theme that seems to be emerging this year is there's been a bit of a resurgence in M&A activity, mergers and acquisitions. How are you seeing that trend play out? And I guess, do you have any views on where to from here, from a broader sense and also from a more specific sense, any companies that you think are ripe for the takeover?
Yeah, so we are seeing M&A tick up. I mean, it was interesting, like with our domestic team, the Aussie market's seen a ton of like deals. And so in our, like the micro cap guys and so forth, they've had lots of takeovers. For us, it is starting to pick up. So we had a Spanish listed business called Atlas, which got bid for by private equity and then got a second bid, and then they kept upping the bid. So it's had multiple private equity bids, and it is now, like, they've agreed on a final price. And interestingly, I think there'll be no companies left on the UK market because either they're moving to the US, so delisting and moving to the US, or they're getting taken out because the pound's so weak, or they're just left behind because people have given up or they think they're structurally flawed. So the UK market's seen a lot. In the US, it's been interesting because you've had a bit of a stalemate as rates have gone up. Everyone's trying to work out, well, what's the discount rate I should be using to value this company I'm looking at buying? And you've got the sellers all sitting there saying, I was worth this much, of course I should still be worth this much or even more. And so there was a bit of a stalemate as rates were going up. You are starting to see, when we talk to management teams, they're starting to say, okay, we're coming to the table and we are starting to see deals, willingness to engage and pricing come in to within, a narrower range. So we do think, and I mean, I saw some stats, S&P Global Market Intelligence put out some stats saying 2.6 trillion sitting on sidelines ready to deploy. So huge amount of money sitting there. Private equity buyers and corporate buyers that will be looking, because as growth slows, if you go into a recession, they all look for growth. So we do think M&A will pick up. We do think there is money sitting on the sidelines. Yeah, we've had one get taken out. We had a couple previously, like we've had Entertainment One, we had Biffa, a waste management company. So we've had a few along the way, and Atlas was the latest. And we think there are a bunch. We've owned a bunch of small mid companies that we think would be ripe for the taking because they're super high quality and there's valuation upside.
Catriona, we We recently read in one of your investor updates, you wrote that it's a stock picker's market. So to close out this episode, we want to do a deep dive on one of the companies that's really interesting you or perhaps is a position in your portfolio, and we asked you to bring that today. So we'll step through it. Let's start at the top. What is the company and what does it do?
Sure. So the company I'll talk to you about is called CTS Eventum. So they're like the Ticketek equivalent of Europe. Yeah, a small cap German listed business, founder owned and led. He owns over 30% of the stock. In Germany, they have over 80% market share. In Italy, Switzerland and Austria, they've got over 60% market share. This is a great network effect business. They basically, interestingly, in Europe, as a background, when I go to a concert now, you put everything in your Apple Wallet, it's all digital, Europe's very behind on that. That's only just coming in, and these guys,
Wow.
have the technology, have put in the systems to be able to enable that, which is very margin enhancing as that gets rolled out. It was a business that we owned pre-COVID, and then the valuation got too expensive for us, and we couldn't see the catalyst, so we sold it. And then in COVID, ticketing, entertainment, live entertainment, the worst thing you could possibly, own into COVID, because no one can go to anything, and we couldn't see the light of when we would ever get out of lockdowns, etc. And so the business got really sold off. They couldn't, so they're basically clipping the ticket on each ticket. They don't own the venues or anything. They just clip the ticket on each live concert, etc. And so they have the technology. And so basically during COVID, the stock got massively sold off. We knew it. We knew the company well. We speak to them regularly. Our view was that concerts and live entertainment wasn't dead forever. So we went back into the stock. I mean, it's got a net cash balance sheet. And what's interesting is that artists, like touring, artists, they make all their money. They don't make it from CDs anymore. They make it from going on the road. And that's, so they need to go on the road. And with COVID, they were off the road for 2 years. And so they're all out there now going on tour. And so what happens with the bigger acts is that they start in the US and then they go through Europe. And so lots of them, you've got, whether it's Taylor Swift, except like they've toured America, and so the pipeline of artists coming through for CTS Eventum through Europe is really strong. And so they've cut a heap of costs through COVID. So the margins now are going to be even better. Plus they're rolling out mobile ticketing. They've just acquired the majority stake in the largest French player. So they've got an enormous opportunity there to tie up that market. And interestingly, they're actually also in the US, the SEC is after Live Nation, the biggest player in the US. These guys they won the ticketing for the LA Olympics. And so they're actually entering the US market because they want competition. And so they're coming from, nowhere to be, and they don't care. They're like, sure, we'll go into the US. It's not going to make or break. We're not going to spend a heap of money doing it, but we're happy to enter to offer some competition. It's a very well-run business with founder-led, so well-aligned management team, dominant industry position, multiple catalysts for us in terms of earnings beat potential, because we think when we look at numbers, they've had multiple beats already, but we still think numbers are too low. So yeah, that's a stock we're excited about.
Love it. I love the, pretty nonchalant about going to the US, and also it's like the biggest event that the US has held in a number of years. You wouldn't want to screw it up.
True.
Yeah. So we're fascinated by the research process, and, you're looking at however many companies you look at, and you're trying to figure out like which ones are worth going deeper on. What was the moment with this company where you were like, there is something here. This is one that could be special?
So in this case, it was basically, we think this, like the extrapolating that lockdowns are going to continue forever, and that this business won't survive, and that they won't prosper out the other side, like it is complete overkill. And it was basically that the share price had been hit so much that the valuation was just ridiculous. And for us, it was, we know the business, we know the industry, we know the management team, and we've been given another opportunity in a stock we loved before, but we just couldn't justify. So that's where the valuation discipline comes in on that was why we sold it. It wasn't because we didn't like the stock and the story, but we got given another opportunity when COVID, threw it out as dead. The differentiator was that we thought, no, this business will survive and come out the other side. And interestingly, that massive shift from goods to services that we've seen subsequent to COVID, is obviously massively beneficial to a player like this who's purely selling on that services side of the consumption equation.
So then on the flip side, Catriona, when you're thinking about the risks with CTS, what sort of red flags are you looking out for if you were to have to sell out again?
I mean, one is that the valuation we can't see any more catalysts. Like, we think the earnings beats are done and the valuation is fully reflecting future earnings. So that's why, like we've those two. A red flag can for us can be like value destructive M&A. So M&A can be good and bad. And if they did, because they have a big cash balance. So it's always dangerous when a company has cash sitting on the balance sheet if they don't use it wisely. The backstop you have here is that the founder owns over 30% of the stock. So you'd think he's not going to screw himself by doing a value destructive deal, and he's very conservative. But if we saw an alarming massive deal that we thought they overpaid on or something like that, that would be a red flag. So that's probably one of the major ones.
Well, Catriona, that brings us to the end of our interview today. WAM Global is listed on the ASX. The ticker is WGB. So if you're interested, check it out. It'll also be on the Wilson website. But thank you so much for taking the time all the way from New York. Certainly took a lot out of this. We'll make sure that we get all of those stocks up on our socials as well. Plenty to get through and look at over the coming days. So thank you so much. It's been an absolute pleasure.
Pleasure. Thanks so much, guys.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.